Hello everyone and welcome back to the feed. I hope everyone is having a great day. Make sure you're following and subscribed if you haven't already. This station gives you real crypto news before it's widely known. Before we go any further, I want you to understand this. Hedera Hashgraph is not set up to be used by institutions. It has already done that. The deals have been made, the infrastructure is up and running, and money is flowing, but most small investors are still not paying attention. Today, that will be different. The close-up lens is always a good place to start because it shows the big picture. I think we are living through the most important changes to the world's financial system in recent memory. Central banks are digitizing assets, governments are tokenizing assets, and the world's biggest banks are quietly moving their settlement rails, payment routes, and data governance systems to distributed ledger technology. Also, Hedera's name comes up over and over again when you look at which networks are actually getting that movement, not just in theory or white papers. This is not a story based on speculation. This is the deployment of equipment on a large scale. When we talk about distributed ledger technology in the setting of the world's financial system, we need to be clear about what institutions really care about. Time is important. Prices matter. How much energy you use matters. Finality is important. And finally, government matters. Large companies and banks don't put resources into networks that they don't trust at the design level. They need to know for sure. They need ways to follow the rules. They need a network that can't be split up, hacked, or taken over by anonymous validators whose goals aren't matched with the networks. Hedera takes care of all of those problems at the same time. Blockchain and the Hashgraph consensus method are very different in how they work. It's not a line of blocks. This is a directed acyclic graph, a type of structure that lets nodes share information without waiting for each other and reach a consensus that is mathematically certain. This is something that regular blockchain can't do at the same speed. A Hedera shard can handle anywhere from 10 to 30,000 events per second. When sharding is fully used, the theoretical ceiling gets close to the size needed to handle in real-time global financial markets, national energy grids, supply chains, and government registries. About 7 transfers happen every second on Bitcoin. Even after the merge, Ethereum still has internal problems that make it very hard to use in businesses. Recently, the CEO of Canary Capital said something that needs to be heard loud and clear. Institutions looked at Ethereum and liked what they saw. They then used the open source code to make their own chains. Indeed, that's what JP Morgan did it. They made JP the Morgan chain. If the code is open source and there is no moat, the protocol doesn't capture the value of the organization. It is taken by the institution for itself. This doesn't happen to Hedera. The Hedera Governing Council, which runs the network, is made up of some of the biggest companies in the world. This makes the relationship between the network and its business users very different. These are not faceless miners or validators who don't give their real names. These are regulated, answerable groups that have legal and social stakes in the game. Let's talk about what's going in the real world now, since this data is so interesting. HBAR Futures has been released by CME Group, which is the world's biggest derivatives market. Actually, that's not a small change. With the help of CME Futures markets, institutional capital can protect itself, speculate, and find the best prices on big assets. Only a few other digital assets can now be put in the same group as Hedera because it has a futures product traded on CME. This kind of infrastructure makes it possible for pension funds, endowments, and sovereign wealth vehicles that are only allowed to trade controlled derivatives to do business. Vanguard, an asset management company that looks after more than $8 trillion in assets for about 50 million clients, now offers HBAR exposure. Take a moment to think about that. HBAR is now available to all of its 50 million clients. This makes it one of the most cautious and long-term focused financial companies in the world. That's not what this crypto fund is for. Hey, this is Vanguard. You can now buy and sell the Canary Capital HBAR ETF on NASDAQ. Since it started, it has had 5 months in a row of positive imports and negative outflows. $44 million in October and $36 million in November. The money kept coming in all through December, January, and into February. All of the HBR ETF products added together have now brought the amount to about $93 million. Canary Capital's ETF now holds more than 532 million HBAR tokens, which is about 1% of all 50 billion Hedera tokens that are available. 5 months in a row, institutions have brought in money and never taken it out. The establishment side of this trade is very sure of itself. Think about what that tells you. The on-chain data is just as interesting as the ETF flows. $10 billion have been settled in the real world through the Hedera network. In theory, this is not volume. Real businesses are using this live financial system to move real money. Let's take a look at the institutional environment, which is truly amazing in how big it is. In banking and finance, Lloyds Banking Group made the first trade of a tokenized asset on Hedera in the UK. Money market fund tokenization is done by ABRDN Investments, which is one of Europe's biggest asset managers. It is one of South Korea's biggest banks, Shinhan Bank, that is testing stablecoin payments on the network. On Hedera tracks, Standard Bank handles payments that go across borders. NVIDIA is using Hedera to build verifiable compute straight into its Blackwell AI chips for technology infrastructure. Google has built-in support for BigQuery and has a seat on the council. Intel is working on hardware for AI control on the network. Deutsche Telekom is one of the biggest phone companies in Europe. It works as a network node operator, which means it is part of the infrastructure that makes Hedera work. In terms of government and rules, Wyoming is testing one of the first stablecoins for the state level on Hedera. A land register has been set up in Georgia on the network. A CBDC pilot called Project Arcadia was run by the Reserve Bank of Australia on Hedera technology. Hedera was part of the Bank of England's DLT Innovation Challenge. In the real world, Red Swan has turned $5 billion worth of real estate into tokens on Hedera. The network is used by ARCS, a digital exchange controlled by the FCA. Vera has used Hedera to build a world market for carbon credits. Hyundai is using it to keep track of carbon pollution. Kia also works on supply chain uses. If you look at this list as a whole, with the banks, governments, tech giants, central bank pilots, and controlled exchanges, you won't find a crypto project. You are seeing the early stages of putting in place what could become the backbone of the global economy that is fully digitalized. Let me now talk about this in terms of XRP and other digital assets, since these two stories are deeply linked on a larger scale. XRP and Hedera are not really competing with each other. They are dealing with different but overlapping parts of the same big change, the digitization of global banking. XRP is mainly used for settling payments across borders, providing a bridge for liquidity between currencies and giving financial institutions the on-demand liquidity infrastructure they need to work without having to pre-fund their Nostro accounts. Hedera is working on the bigger picture, including the business layer, tokenization, data governance, supply chain integrity, identity, and the infrastructure for CBDC. What's interesting is that institutions are picking both, and the CEO of Canary Capital made this point very clear. When asked which networks institutional capital wants to put a lot of money into, the answer was clear. Institutions are mostly interested in XRP, Hedera, and Solana, not Ethereum or the old chains that have high gas fees and a chance of splitting. Where the real money is going are the networks that are efficient, well-run, and custom-built for a reason. Everyone who works with digital assets needs to know this because it tells you something important about how the next phase of the market will grow. The 2021 cycle was mostly fueled by store speculation and DeFi trying new things. The current cycle is being formed by how institutional capital is allocated, and institutional capital has done its research. It has looked at the network's technical design, ways of meeting regulatory requirements, governance structures, and usefulness in the real world, and now it is putting its bets. It's not an accident that both XRP and HBR are at the top of institutional priority lists at the same time. It shows where the smart money thinks this space will have long-term value. Let's talk about the legal aspect in particular, as it is quickly becoming the most important factor in deciding which assets get large amounts of institutional capital. Hedera's membership in the Digital Monetary Institute, a global group of central banks, financial institutions, payment providers, and tech companies, is a big deal that hasn't gotten enough press. The DMI's job is to help make decisions about how central banks should handle digital currencies and the future of money. Coin speculation projects are not allowed to join. It's only given to groups that are actively working to improve the global monetary system's policy framework. Hedera is now a part of that discussion. It works together with state banks. It's giving information about the growth of CBDC. It's helping to shape the rules that will control digital currencies for many years to come. This job is not on the edges. Here is a place at the table where the rules for the next banking system are being made. This is the strongest statement that can be given from a regulatory point of view. Regulators don't bring risky assets up when they talk about CBDC policy. They want infrastructure that was built by groups they can hold responsible and that they trust. With its governing board made up of Fortune 500 companies and global institutions, Hedera is the only company that can do this kind of regulatory work. The difference with Ethereum can teach us something. Ethereum's strengths have always been that it is decentralized and has a strong community of developers. But when used by institutions or the government, that same decentralization turns out to be a problem. As of now, there is no governing body to call. There is no responsible party to talk to about compliance issues. Institutions that need clear rules from the government can't get them from a network where no one is in charge. Hedera is made to solve that issue. For XRP in particular, the path of regulation is just as important. Ripple's legal problem with the SEC has been resolved, and while it is still changing, it has made it possible for institutions to get involved in a way that wasn't possible before. And the fact that regulations are clear for XRP and Hedera is taking an active role in global monetary policy talks makes it a powerful 1-2 for investors who hold both assets. Let's take a look at where HBAR is technically and what the short-term price movement tells us. At prices close to 8 cents now, HBAR is selling at a big discount to its previous cycle highs, which were around 45 cents. There is what professional technical experts call a clear accumulation breakout pattern on the chart. For months, the base has been getting stronger. The pattern of the volumes is more like that of institutional accumulation than of retail gambling. When assets that have been building up in value break out, they usually do so quickly because the marginal seller has been used up and the supply glut has been taken care of. There is also more to the catalyst story. You have CME futures helping institutions find prices. For example, the Canary Capital ETF has steady inflows that keep the buy-demand high. Vanguard Distribution is letting 50 million individual and business clients buy the asset at the same time. On top of that, the network underneath keeps growing. 34 million Hedera consensus service transactions have already been made by Hashgraph Online, and the infrastructure for the registry and agent finding is still growing. The announcement of the ecosystem growth through the partnerships between Halon, Hashpack, Hashgraph Online, and Gfinity is very important because it fills in a major gap in the Hedera story, developer tools, and user onboarding. As a top non-custodial wallet, Hashpack makes it easy to access DeFi, NFT, and dApps on iOS, Android, and browsers. Halon adds Web3 security that is good enough for businesses to the network design layer itself. These are not just extras for looks. They are the building blocks that turn a highly advanced network into one that many people use. Also, the basket ETF risk is going up. Bitcoin, Ethereum, XRP, and Solana currently have the most weight in multi-asset crypto ETFs. HBAR's inclusion, even if it's only a small percentage, sets a very important standard. As the price of HBAR continues to rise and its market value rises, its algorithmic weighting in these goods will also rise. This makes a compounding effect. Price increases are caused by institutional inflows. When prices go up, the index ranking goes up. More money comes into institutions when the balance is raised. When you look farther out, 12 to 36 months, the way the forces are coming together around Hedera points to a possible repricing event that not many people are ready for. Things in the real world being turned into tokens is not a trend. It's a big change in the way global stock markets work. Every big bank in the world is building infrastructure for tokenization, including BlackRock, Goldman Sachs, JP Morgan, Fidelity, and more. McKinsey thinks that by 2030, the market for tokenized assets could be worth $16 trillion. If any of those networks can get even a small share of that settlement flow, they will be worth a lot more than their present prices suggest. Hedera has already made $10 billion in payments in the real world. On the Red Swan network, there is $5 billion worth of tokenized real estate. Tokenization of money market funds is live on ABRDN. This group is not a pilot. These are shipments for production. From here, the range from 10 billion to 1 trillion is the kind of growth path that makes investors rich for generations if they get in early. The long-term case for HBAR is not that it becomes a famous crypto token for everyday use. Because of this, it turns into infrastructure that can't be seen. Billions of people use the rails that support global banking without even realizing it. In this way, Microsoft came to be Microsoft. That's how the internet came to be. The core layer doesn't get much attention, but it's where the money is made. Early investors in the internet era who saw this trend coming made a lot of money. Those who see it now in distributed ledger technology and set themselves up in a way that takes advantage of it have a similar chance. This is the last thought I want to leave you with. In this market, the question is not whether or not big money is buying digital assets. It's already here. That cash should be put into which assets, in what amounts, and over what amount of time. Inflows into ETFs, memberships in governance bodies, settlement volumes in the real world, and the clear views expressed by institutional allocators all point to a small group of networks. That list also has Hedera and XRP on it. For now, most buyers still see these assets as risky crypto tokens. Institutions are starting to price them as important to the economy. When those two prices come together, which they will, there will be a big, long-lasting move that will be hard to catch if you are not already in the right place. In the story of Hedera, this is the big picture. It's not hype.